I'm Eleanor Hill, Treasury Editor at TTP, and we're just over 3 months into TTP's journey, and what a ride it's been. Today we've got something very special for you. It's our first ever live podcast recorded at the Lansdowne Club in London at our newly launched TTP Breakfast Club.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance.
So welcome to the Breakfast Club, everyone, and this live podcast recording. So today's panel will focus on supply chain finance, what it actually is beyond the buzzwords, and how we can grow it, covering everything from SMEs to emerging markets and non-bank players. We'll also touch on regulation, onboarding headaches, legal agreements, deep tier financing, and all of the acronyms that we know and love. So we have here representatives from Citibank, EBRD, Merkur and Sullivan talking about where supply chain finance is going. We're delighted to have Jeff Wynne, who is a TTP editorial board member, as moderator for today's session. And kind thanks to Sullivan for sponsoring this breakfast. Now over to you, Jeff.
Right. What I said to Deepesh as the first subject was that supply chain was clearly a good subject, but we would all be bored with the idea of just talking about supply chain. So the title is who can really grow it and how? What are the obstacles, opportunities, action plan? We have a really good panel. Can I invite Mollis to come up and join us?
Daniela Bardier. I'm a partner at Sullivan and Worcester with Jeff. I work across the full suite of trade finance, supply chain finance, structured trade finance, export finance. Work a lot with DFIs.
Anthony Wadsworth-Hill. I'm with Merkur. We are a fintech group that established around about 4.5 years ago. We have 3 operating companies. One which is a compliance consultancy, which goes into all the banks and helps them get through their financial crime and regulatory issues. The other is a IT company, kind of the fintech piece, which works on building out the trade execution enablers. So lower cost of execution, a better KYC processes, it had a better risk management. And then the third piece is Merkur Capital, which is an FCA registered trade and supply chain finance provider, focused on providing finance to companies caught in the gap.
Hi, I'm Parvez. I am with Citibank. I manage their global payables finance business for the last 5 years. As you know, Citi operates in so many countries. We offer buyers based in 88 locations and the supplier based in 125 location deals with huge amount of currencies, around 106 currencies we deal with. Market leader in payables business, has a market share of 24%. Market leaders now in receivables as well, which has picked up extensively well this year because of the tariff.
Hello, welcome. My name is Mark. I work for the EBRD's Trade Facilitation Program. EBRD is headquartered in London. We are a classical multilateral financial institution. We are owned by more than 70 governments. We invest in Eastern Europe, about the ex-CIS countries, Balkan, and some of the Middle Eastern and North African countries. And in those countries, we have a lot of investment potential from classical investment products, equity, financial institutions, and trade finance. And I look forward to this discussion this morning, actually, on the supply chain finance, which is also a topic for us as a multilateral bank.
Let me just give you a quick introduction to where I want to keep this discussion. It's about trade. Trade is about buyers and buyers. Buyers supply goods and services, buyers pay for it. In simple terms, suppliers want to be paid early, buyers want to extend the payment terms. The middle ground is supply chain finance. That's really the base. Buyers have receivables, buyers have payables. The supply chain finance sits in the middle of all of that. Many of you say, well, what's new about any of this? And the answer is, in reality, there's nothing new about it. What is missing is that there is this huge trade finance gap. and it's mainly driven by SMEs who cannot get financed. So what I've specifically asked the panelists to think about is not the very high visibility supply chain finance transactions, but seeing the extent to which we can make supply chain work in SME markets, in emerging markets, and so on. And that seems to me, that's the real challenge for the discussion, because you can grow it only a limited way if you only have a limited number of buyers. If you would expand the number of suppliers, the number of buyers, we can grow this product. What holds it back? Well, I'll throw out things like KYC issues, legal issues, structuring issues. These are the sort of things that I hope my panelists will, in their opening remarks, look at. I'm then going to give you a chance in the audience to lead where this discussion goes. If you're asleep by then, we'll wake you up in some other way. But think about what you might like to ask. Marco, you're sitting at the end.
Okay, trying to answer your question, I'd like to elaborate a little bit further and would like to go back in time of what the EBRD and us in the trade facilitation program have done over the last 20 years. We invest in Central Eastern Europe, which is a more advanced market. And then we also deal with the early transition countries, specifically maybe in Central Asia, in the Caucasus region, which are not as advanced in their economic transformation. And we, in the trade facilitation program, besides issuing guarantees for letters of credit to our confirming banks, quite early saw that there is also a demand for supply chain finance around 20 years ago. We defined it more as factoring. And what we tried to do, for example, in Georgia, Armenia, is we wanted to have technical consultancy projects to really get the market to a better SME financing, a better supply chain financing. But what we realized fairly soon was that it was too early. The market was not ready to receive the technical assistance we gave them. A couple of years later, almost a decade later, we tried a second try, and then it started to work. And now, for example, in Georgia, Armenia, you have a functional factoring market, and we're also getting into a better way of supply chain finance. For example, last year we were in Greece because we invest in Greece. Only now the market in Greece, as a sophisticated market, is waking up to supply chain finance. So we already invested in factoring companies because no one wanted to give them money during the financial crisis. But the factoring companies did kind of a reverse factoring, so supply chain finance at the end. But the banks themselves, who have a factoring operation, they are now working also on specific supply chain finance. And also us as EBRD, we only woke up to the terminology of supply chain finance around 2 to 3 years ago. And within the EBRD, actually not within the financial institution, but our SME department created a supply chain finance program where we work together, for example, with a Citibank, because us as EBRD, we don't have the technology, for example, to work really with, let's say, the anchor buyers and the SMEs. So we have to have intermediaries in order for us to be able to conduct the supply chain finance. Why am I saying this? Because us as EBRD, we also have limitations. So as a multilateral bank, we obviously bring in, and this is also one of our transition impacts, which comes down to the United Nations sustainability goals. We are supposed to motivate private capital. We bring in the consultancy. We try to green certain stages of the supply chain. So what we do, for example, with Citi is that we work then with the SMEs, bring in consultants in order to green the supply chain finance and bring in the terminology to make the whole supply chain finance more sustainable. But what we cannot do is, as a multilateral, is to provide only financing. So I think this is one of the shortcomings, of course, which we have, because companies or a lot of corporates are looking to a multilateral like us to provide the financing, but also this makes it more complicated to work with. So there's no sugarcoating around. EBRD has its transition impacts, which we have to include, but then the rewarding effect is that we set certain standards and make the supply chain more sustainable. To increase supply chain finance, of course, what we're trying to do with our limitations, which we have, because we also have capital constraints, there's a certain amount you can do in terms of providing liquidity to supply chain, is to digitize the supply chain. So in order to move away from this document-centric, more to data-driven terminology. I think this is one of the buzzwords. So IT companies are really in the forefront of that because we bring in the framework where we try to educate our partner banks to become more digital. I think this is one of the ways to improve the accessibility to supply chain and to have more liquidity to get to the market. But of course, the elephant in the room is how SMEs receive the financing. One of the ways is digitization as one of the focus, and also the recent approved capital framework, which our shareholder, the 70 governments approved only a month ago, is digitizing the economy. So we have a huge effort in providing more digitalization to our partner banks for the trade finance section. This will not be possible without the partners which are sitting on that room. So I think this is just really a little bit of a framework of what we do, how we see it at the moment, but happy then, of course, also to elaborate a little bit further, what we can do together. Yeah,
that's great. Some key words that we may well come back on: factoring, use of intermediaries, and digitalization. We'll come back on that. Pavis, you've been mentioned a few times, payable side.
I have multiple instances which can go in the same direction of the travel which Jeff and Marco mentioned. I took over this business 5 years back. The business was exactly half of the size what it is today. Everybody wants to do supply chain finance. I cannot imagine any bank who's not interested in doing supply chain finance. And how did we double up this business in the last 5 years? I'll give you a few anecdotal examples of how this business evolved. Our market share is now at 24%. That is number one. While I manage the entire payables business, our receivable businesses have also done exceedingly well in the last 2 years, thanks to multiple facets of how this business has been developed. The first and foremost is onboarding. That's a first bottleneck of any supply chain ecosystem that you want to build. The more user-friendly, the more digital, the less intrusive onboarding you do, the better for any SMEs to come and participate. When we took over this business 4.5 years back, we used to have an entry barrier of a supplier above a threshold. We will only onboard, otherwise we will not onboard, because the onboarding efforts cost a lot to the bank versus the return for the full year on that particular supplier. So today, I can onboard a supplier which has got a $1 million spend to a $1 billion spend. So my universe is from as low as 1 million to as high as $1 billion. And they are all treated same from an onboarding perspective. Why is that possible? It is because of digitizing the entire space of how an entry barrier is created. But at the same time, enhance the KYC, AML, sanctions, anti-money, whatever you can call it, from a hygienic perspective, from a compliance perspective, from knowing the counterparty, whether he is operating in his bank account, whether he is actually a legal entity or not, to where you are making the payment. And that has to happen. You cannot afford to have leaks there, because one loss could wipe off your entire year of profit. So that is my first work that we have done. The second is the legal due diligence. It's so critical. When you operate in 88 countries, you need to know what are the perfection requirements in a particular location. Whether you need to sign a notice of assignment, whether you need an acknowledgement, whether you need to register a UCC filing or not, all of that you need to do at the backdrop and at a speed at which the supplier gets paid immediately. That's the second big, and there's a lot of investment that the bank has done over the past many years, and we keep refreshing it. It's not that once you've done that due diligence, you'll sleep on it and hey, hunky-dory. No. Every 2 years, you need to look at what are the changes that have happened in the respective locations. Secondly, are you compliant to the local regulatory legal framework or not? And I mentioned regulatory because there are many countries. You can imagine we offer buyers 88 location, supplier in 123 location. So you need to know at the tip of your tongue that a particular country has a central bank requirement to report an invoice or to check an invoice whether it is genuine or not. And that has to be complied. The second is this entire legal regulatory framework which will operate like a machine when you are dealing with a counterparty in any and every location. The third and the most important part is the technology rails. What technology rails are you building? To Marco's point, paper. In our receivable business, there are only 10 or 20% of paper coming in. Everything is digital. The reason we have created this digital rail, and when I look at supply chain, we offer in 88 locations, out of which only 5 locations are on a different platform in LATAM. Rest of the 83 locations are on one global single platform. So a supplier which is onboarded in, say, Thailand to a supplier in Peru to a supplier in Canada, they get the same technology, same touch and a feel, same experience. And possibly a supplier could be dealing with 20 counterparties or 20 buyers. When he logs in, he sees all that program, he's participating with the usage, etc. And that's very important because we are connecting to the ERPs of the buyer universe. We are collecting the data from the buyer's ERP, processing it, looking at the credit, looking at the AML sanctions, etc. And same day, the money reaches the supplier either through instant payment, bank transfers, wire, whatever payment rails that you create, that entire engine has to work clockwise so that the supplier gets paid ASAP without any delay. And that, I think, is the most critical part, which has proven a great tool during COVID. In COVID, our business went up 38%. Because of the digital investments that we had done previous 2 years, people were not very supportive when we put up the technology ask 4.5 years back, saying that this is an outsized investment. You don't deserve so much of money. And today they are offering me money, or what more you want to invest. So you need to believe what you are doing and how you are delivering it, right? If a supplier 5 years back used to sign physically, the documents used to reach our office, somebody will check it, everything has become digital. 60 locations, we can take signatures digitally, and that kind of gives the supplier comfort. You have to think it, and lastly, we started thinking from a supplier lens perspective. What does the supplier need? We have done very well with the buyers because the buyers are the relationship of the bank, of multinational companies, which deals with billions of dollars, makes tons of money for the bank. So you have a great relationship, which is fine, right? But the supplier has never dealt with a kind of a large Wall Street bank. He gets paranoid when he walks into Citibank or any large multinational bank. They're going to rip me apart. So you need to think through from his lens, what does he need? He needs money to reach him on time, number one. Number two, he wants to complete his value chain. You have to think through how his entire value chain is operated. Where is the pain point? The pain point is when he receives a purchase order, that's a starting point. He needs money to manufacture the goods. Are you able to provide him funding at the time when he receives a purchase order? If the answer is yes, you are a winner. Because then he is getting money not based on his financial strength, but based on the flow of the goods. To Jeff's point, it's all about dealing when the goods are exchanged between a buyer and seller, and are you able to complete his value chain throughout the multiple cycles is the most important part. And we started wearing the supplier from a supplier lens. What are his needs? So we developed products like FX to him on an instant. We developed the purchase order financing. We developed the sustainable supplier financing, which he can get a better rate if he is sustainable as per the standards laid down by the buyer. And I use word sustainable and not ESG because ESG has its nuances, and some large government is not very favoring D&I, and we don't want to talk about it. But exactly the point, when we started offering sustainability into supply chain, it was again a question mark. Why are you offering the discount? The capital returns are not adequate at a price at which you are giving. The logic that we used was that you need to have that in place because there are a lot of green investor, and I'm coming to the investor piece because there are a lot of participating banks and my partner sitting in this room. They need to see this in the same order and fashion that it is being originated. You need to have that environment to put it in the market, absorb it in the market, and deliver it on a continuous basis without any disruption, without any failure, without any losses, without any issues coming up. That trust, that visibility has to happen, and then only you can operate at a scale. Otherwise, it's impossible with your capacity to deliver a holistic solution to any ecosystem in the world. I'm lucky that I have a large balance sheet supporting me. I have large relationships across the globe supporting me, which is an advantage, and that plays to its strength. But unless you have this entire ecosystem working in a very cordial way, it's going to fail. Once it is failed, people will stop using your service because it is disruptive to their core business. When you're offering flow-based financing, you need to think through that the moment you take a knee-jerk reaction, his manufacturing is stopping, his sales are stopping, and he would not ever trust you. Second, so during COVID, we are a large distributor of the supply chain, largest in the market. You cannot imagine. We are like 10 times size to any other bank in terms of distribution. The market investors' prices went sky high because of the COVID. We didn't change the pricing. And that was a moment of change within the organization that I had to fight battle for 48 hours to say that I'm not going to change the pricing, regardless of my investor pricing went up. The reason is that supplier is at the most receiving end. If you change the pricing, then he is anyway bleeding. He'll die, right? So that was a decision which actually today, when I sit back, I'm very proud that we took that decision, and that made a lot of comfort to the entire ecosystem that this is a long-term sustainable model. It's not disruptive. It's not going to throw me the baby out of the water when we need the most, and that changed the game. So I'll stop there.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Anthony, you had lots of lines fed to you, intermediary, digital, with a space. There's a space below where City are working.
Yeah.
$1 million space. You got a solution for us?
Covered a lot there. This is ultimately a cost of service challenge. And the seminar is titled Who and How Can We Resolve This? Who is banks and non-banks. How is technology and automation. The thing that we're trying to navigate currently is how we get the technology and automation into the lenders. The banks inherently have the upper hand in this because they've got the balance sheet and liquidity. But the non-banks have more agility around developing technology solutions, reworking their business processes, and to be able to right now play a role in origination, structuring and execution. Parve has gone into detail around how on the Citibank side, combining the fact they've got a huge technology budget and network of resources, we got well ahead of the game. There are a number of banks that we are performing KYC or financial crime related remediation projects, a heavy flavour of trade within their portfolio. A big stack of that is around the cost of service and getting that KYC or automation piece in play. In the SME trade sector or SME supply chain finance space, the yields are there, right? Like you don't have to be exploitative, but on a annualized basis, when you're dealing with an SME supplier selling to a reputable buyer, there are opportunities for yield. The issue is, and I guess a lot of the banks in the room, I mean, I'm a former banker, 20 years prior at ABC, is the flat charges that we have that would end up destroying that SME business if we were to apply those to the suppliers. So we need to find technology solutions that enable us as originators to take away those flat charges and work on the yield basis and originate at volume. Now, where non-banks generally have the benefit is to put together that business process, not necessarily reinventing the wheel. There's a lot of great technology solutions out there, but actually building and connecting those technology solutions together be it from a transaction management point of view, from a screening point of solution, joining them together in a way that it makes sense for the customer journey, in a way that it makes sense for the supplier to submit their initial request for finance under either their supplier or buyer-led program, or whatever it is you're running in your organization. You can engineer the processes such that whoever is submitting the request on your online portal does most of your operational booking. They're uploading details of the trade, that feeds into your operational systems, ends up creating the booking in your core systems, automatically makes a call out to the APIs to do the screening. Human resources aren't performing administrative tasks, they're performing value-add tasks, true risk assessment tasks, and analysis of hits, whether they're false positives, etc. But that's how we've sought to build our process. We're learning from the experiences of doing all of our remediations and understanding what works good, what doesn't work so good, and trying to build an operational process that supports that better. So that's on the KYC piece, and I'm seeing stacks of that inherently. Then the next part of the cost of serving supply chain finance in the SME space, cost of execution and speed of delivery. So things like the ETDA coming in here and being able to leverage digital negotiable instruments or digital execution in some form. We don't have to do everything against a digital permission anymore. I was brought up in a forfeiting background, so I'm inherently always trying to make a digital forfeiting house, but that doesn't always work. As Parve's alluded to, we don't have one piece of paper in our business either. I don't want to layer in those processes into the blank canvas that we had from 4 years ago. We don't want to exclude anyone from accessing finance, but we just need to have a think and try and get the legal documentation right, work with good legal partners that help us find pathways to do that. So if you can bring in a way to service the KYC aspect at a lower cost and try to think about it as syndicating the cost of KYC, if we do it right and find a way to passport that information into prospective funders that may work with Merkle in the background, they can utilize all of the work we've done at a lower cost point to them to make the sign off, then that's going to encourage more liquidity to come into the non-bank originator network. A lot of the banks are wanting to go digital, don't know how, have extremely long layered governance processes, new product committee processes for the right reasons, but I think most people fear putting up a new product committee paper and the length of time that may take to get through. So working with a non-bank style originator can help shortcut that. So by being able to bring that digital execution piece into play. And then the other piece is concern around the NBFI sector and NBFIs blowing up, things that should have been detected. So NBFIs need to work on providing trust to downstream FI partners. How can we do that, right? Now, we are working international trade and are used to traditional trade products using correspondent banking networks, going into developing markets where we know that they have insufficient control frameworks. On the LC side, how do we deal with that in the bank-to-bank space? We deal with that with correspondent bank reviews combined with potentially on-site visits, overlaying additional controls at your end where you need to, where you highlight deficiencies. You still try to serve the trade corridor. And that's what we also need to do between the FI and the NBFI market, actually try to work with and find out who are those trusted NBFI originators, build in a correspondent banking style layer review and audit process, and therefore you can get the confidence that you're working with the right people to originate and that are going to be there, this time in another 5 to 10 years, etc. So I think it's definitely a combined effort between banks and non-banks. The banks at this stage need to work with partners who have got the technology in place already and can move quicker. In the long term, by the time all the banks have got all the technology in place, then the question would be, is there a place for the NBFIs, or will the FIs have bought the NBFIs and taken them out of the market?
Yeah. And lots of bits of legal all over the place.
There are lots
of solutions.
The one thing that I was wanting to focus on, and just to add to what has already been said, from the legal perspective, we come in to all the various elements. And if we are looking at how we're going to grow supply chain finance, how we're going to access, a wider market, how we're going to increase the liquidity, you have to look at what we're doing right now in terms of how liquidity is being applied. There is a lot of documentation that comes in, and there's a lot of time that is spent in that documentation, which, not to be said that the lawyers are the roadblocks, but that lawyers spend a lot of time and there's a lot of money that is going into this. So from my perspective, there's a lot to be said about harmonizing that documentation. At the basic level, you have the templates that each bank produces to speed up the onboarding process, the supplier side of things, the buyer side of things, and the participation of the DFIs or the participation of other banks to enable that liquidity, that capital to be raised. And it's in that space that I've been seeing a lot of room for harmony, for maybe, the use of a BAFT style document, a BAFT plus, dare I say. Everybody knows that the funded participation or the unfunded participations that are done through the BAFT document. The BAFT document wasn't designed to be used in supply chain finance. There is an update that has been made to the draft to bring in the ability to supply chain finance. But then we're also bringing in different parties into the system. The BAFT was much focused on the bank to bank of risk, but then you bring in a bank and a DFI or an MTB entity. These documents are not really fit for that purpose. There are different motivations that the parties bring to the table. You end up with, a Frankenstein BAFT document because it's BAFT inspired, but nobody can read it except for the lawyers. There's a certain element of, let's harmonize that. Let's stop spending time and wasted efforts on fine. We get the product. Getting the new product through the banks approved is difficult enough. And then to have the other added hurdle of the documents taking really long time to negotiate is often an issue. That's on the participation side. The other way that we can increase the liquidity, that we can increase supply chain finance, is through the use of guarantees. A lot of entities are looking for guarantees from the bank side to limit their capital maintenance requirements. There is also a bit of a roadblock in the documentation there that I keep seeing, in that these guarantees are meant to be unconditional. They're meant to be for the benefit of the beneficiary. But so long as they meet certain conditional statements in the document, then the guarantee will pay out. But in that conditionality, there comes a hurdle for the banks to be able to use it, because you need to ensure that you stay on cover, that your product can meet the conditions and stay on cover. Well, that means for a lot of institutions that you need to put processes in place to ensure that you don't go off cover, to monitor that guarantee. And that might be too expensive. There are efficiencies to be made if we were to harmonize, to have an agreed industry template for this particular type of transaction. And then also in the guarantee space,
we've had some really interesting solutions. The one thing that we haven't actually talked about is educating suppliers and buyers, because yes, we want to digitalize. Yes, we want to keep it simple. Marco, you talked about factoring. Anthony, you talked about digital negotiable instruments. Trying to get to a position, just as a thought, educating SMEs that actually their documentation is quite often a bit too complicated, is actually very difficult to understand. And the buyer obligation, if he would only evidence his obligation in a simple way, we might be able to finance it more easily. So just the thought is the key, actually, the education at the trade level, rather than everything else that we've got. Audience, any thoughts, comments?
But could we talk a little bit about the performance risk? Because if you are talking to SMEs, who is taking the performance risk of this SME selling to a big client of Citi? Is that the big client of Citi? Is that the bank? Because I would have thought this is one of the primary risks.
So I think when we develop the purchase order solution, the key element for any well-defined structure is to identify the risk and how you park that risk so that you have very well documented structure. And that's one big data point for any structure, whether you talk about portfolio receivable finance, etc., etc. And the risk keeps changing as your cycle evolve around the working capital flow. So if you are issuing a purchase order, you are taking 100% performance risk on the supplier. The buyer will say, I issue a confirmed purchase order and I will buy the goods when they are shipped as per my contract on the time, at the price, at the location, at the terms that I have mentioned. He has issued a confirmed purchase order unless the supplier performs, delivers in time within the parameters. The risk resides with the supplier. Now, how do you box that risk is the key to the success of a purchase order financing. And we kind of cracked it on a portfolio basis.
Anyone want to pick up performance risk?
I think from the multilateral perspective, because we rely on the intermediary, the risk is not with us. Simple answer.
So we take the risk.
But if we're talking about pure supply chain, there isn't the performance risk because
the goods are shipped here.
The goods have been shipped. In supply chain, you don't need to worry about performance risk, do you?
Yeah, because you're dealing with the post-shipment. In the supply chain, you're dealing with after the goods have been delivered, right?
That's fine. I thought you had said that you were providing finance to help the guy produce the goods.
Correct. That's a purchase order financing that we are offering on a portfolio basis where we take the performance risk of the supplier.
Understanding the risk and who takes it. Anybody else?
Tapping into the point around SME education, because it kind of links in with this performance risk piece too. We spend a lot of time getting to understand our clients are SMEs. We work with a lot of SME suppliers, and the SME suppliers may go to their high street bank and say they can't extend their overdraft. Yet we look at them, we say, hold on, you're selling to a buyer name I recognize. Why don't we try to structure something around that? We get into that discussion and we talk to them. We say, well, on what terms are you selling to them? Oh, it's like net 30 open account and net 30-day open account terms. I'm like, oh, okay, so when do they pay you? They ever pay you on 30 days? No, never. They normally pay us on 60 days. Okay. Well, that tells me that the buyer wants to pay you later than the terms that you're agreeing. Why don't we try something on your next contract? Oh, what's that then? Well, I don't really want to take your performance risk, but I'm happy to take the risk of the buyer. The buyer wants to pay later. In your next sales contract, why don't you put some optionality around the payment term? We've done this several times with our customers now. We say you can either pay on 30-day open account terms, or if you accept a bill of exchange within 10 days from shipment, you can have 90 days. And where we're working with companies that we can put a digital piece around, we would seek to execute that via a digital bill of exchange or promissory note and then get them paid faster. But it's about bringing that in so that we've eradicated that underlying performance risk in the buyer.
I like this as a solution, educating SMEs, getting their documents right.
Jeff, I just want to touch on some points. We talk about digitization automation a lot, and this is clearly a component of what we do. I think the one thing that pertains to this, we have many small niche pilots that we all do, looking at different buyers, different suppliers. One, are they scalable? Are we doing it just because they're the largest clients and it makes sense for that particular transaction? Two, are our own risk and compliance processes uplifted enough to take advantage of all this digitization automation we have? It's great we have this transparency, but if my KYC and so on is back in the 1930s, I'm not necessarily taking advantage of some of these processes we have. And then the last piece I think is most important is that, do we sit here and say the corporates who are doing some of these smaller pilot elements, are they the ones who are going to be the market leaders and tell us as banks and MBFIs what they want? And then you have to design solutions based on that. Or as we say, are we going to be the market leader? So I know there's 3 points within there, but this ties into how you make supply chain and how you deliver this. and who's going to be doing that in the future.
Helpful and interesting. Were you going to say, yeah?
I had a question. So I think, again, for Karvay, sorry, that we've talked a lot about digitalization. We've talked about, obviously, all parties need to be developing on that to deliver against the agenda. So what kind of help, financial or operational, do any of you offer to get them on the digitalization?
When you deal with core trade flows, you are dealing with a lot of third-party service provider, which has no incentive from a return on investment perspective to create the infrastructure. And when I talk about third parties, a kind of shipping company or an insurance company or a certificate agencies, etc., they will throw in papers at you. You need to have a bridge to convert that into digital. That bridge, if you create in such a way that it's less intrusive and does not sit into the ERP and not a heavy investment, you will be successful. Secondly, I think the education to the SMEs, regardless of whatever you tell them, they will have paranoism around coming and opening an account or doing a KYC digitally. What we have done is we show them what we know. So we have a lot of data lakes that we connected it, and we can extract a lot of information. In fact, we have developed a credit passport in the back end from a performance risk perspective to offer a portfolio. Data lakes provide you, let me finish that thought. Data lakes provide you the information. If you show them, they just have to validate and accept that they are current and valid, and that makes the journey a lot easier. And so to a certain extent, we also fund the investment from a connectivity perspective to the large buyers. So we do the investment
for the connectivity. Complicate a little bit, because in fact, Parvis threw in that horrible word blockchain, which half this audience will love and half the audience hate. You can be simpler on what you mean by digitalizing.
I get that point, and that's where I was asking. Do you actually work with the integrators? In the sense, do you make the consumption of technology easy?
We created our integrators in a way which can connect to the ERPs of the world. That is very less intrusive. The more intrusive you make, the longer time. So just create an integrator. It can talk to any ERP and it's quicker to implement.
I would have said just don't mention digital. Just sell what the ultimate benefit is, that you're going to get your money quicker. Suppliers want to get paid quicker. Buyers want to extend payment terms.
The regulatory environment that big banks work under makes it very difficult on KYC. And you would not be surprised for me to take a pop at the regulator, because the regulator doesn't actually understand how difficult the regulator has made this, because it's more worried about protecting the banking system than about protecting and expanding trade. The more the regulator will allow third-party suppliers of things like KYC services, the quicker we will be able to onboard more and more SME suppliers and buyers. That's what's holding a lot of this back. You're absolutely right. But you get to the scalability. If we can make it simpler, we can scale this more quickly.
So there was a mention about using technology in the KYC onboarding on the platforms. Where are we in the journey of using technology on the legal side of that? Because weeks and months are spent in negotiating contracts amongst counterparties. So how can we shorten that period? Sometimes by the time the contract is signed, the opportunity is gone.
That's not our fault. That's you and your customers. We can do it much quicker. But you all insist on clause 27C.
These are template documents that the bank put in place 20 years ago and are now sacrosanct. And nobody remembers why this provision is there, but you cannot remove it during negotiation unless you have sign-off from 5 other departments. Well, that ties our hands. So
listen to what Anthony was saying. Persuade buyers to issue promissory notes, accept bills of exchange, and your documentation becomes more simple. The problem is that if you look what sits behind a supply contract, it's 500 pages of what you negotiated 20 years ago. Nobody knows how to change it.
We had cracked that. So we have like 50,000, we onboard huge universe of suppliers. For supplier documentation, we have looked at 7 years of history, and we compartmentalize the document into 3 parts: amber, red, and green. The greens are authorized for the supplier engagement managers to negotiate and delete or whatever. Alternate languages are digitally provided. And the red one comes to us as an approver to approve it. That made the process much quicker and faster rather than spending lawyers' time.
When I started almost 20 years ago, there were around 40 pages. Now there are 70. It's exactly what Daniela said. Clauses have been included and it's very difficult to get rid of them. But as a multilateral, we thrive to set the standard. So I think we're also a little bit proud to have these 70-page contracts. It is an issue.
Yeah, invest in your technology and your process engineering. Have a think about that. But really don't forget what the customer wants. I spend a lot of time in panels and conferences talking about reliable systems and things like that. The customer doesn't even know what that is and they don't care, right? The customer just wants to get paid quicker.
Daniela, 30 seconds.
Let's be succinct. There is a huge push to harmonize the documents, to make them shorter, to use templates. Like there should be an industry drive to do this. Yes, we have lovely documents for EBRD that are 70 pages long, but there is also a lot of sharing within the DFIs of knowledge. We see this often enough that now DFI documents look very similar, and that helps. So when you're dealing with one DFI, you know that you recognize that document. Let's expand that.
Think about what the customer wants, educate the SMEs, and we will solve the problem.
Done in 1 hour.
Panel, thank you very much. Audience, thanks for listening.
Well, a huge thank you to our panelists and, of course, to Jeff for such an insightful session. Finally, thanks to all of you for coming, for supporting us, bringing some really great questions, and, of course, for being on your best behaviour for our recording.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.